My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. My friends, I'm just trying to help you make a little money. My job is not just to entertain, but to explain and educate. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. All last week, I told you that rather than selling everything, you should just sit on your hands. Because once the pain ends, we're going to bounce right back. Sure enough, the averages were today, with the Dow gaining 484 points, S&P jumping 1.16%, NASDAQ also climbing 1.16%. Okay, I know, it's nowhere near making it back, but it shows you that selling into Friday's vortex didn't work as a tactic, did it? If you recall, last week represented a disaster for some of the most economically sensitive stocks, as well as tech. I couldn't make sense of it, because the only big thing that happened last week was the August employment report, which showed mild growth and a sizable revision down for July. To me, this was a great number if you're hoping for Fed rate cuts. We needed a Goldilocks set of figures, not too hot, not too cold, and that's exactly what we got. Wall Street disagreed vehemently, though, with my view. The market reacted as though we were headed for a recession, with people dumping the cyclicals and buying the slowdown plays, like the consumer packaged goods stocks, drug stocks, that kind of thing. The industrials and the semis were really hard hit, especially, well, I got to tell you, the industrials, mind-numbing. And I'll tell you why. We had Caterpillar's Jim Umpleby, the CEO, on Thursday night. Geez, I thought he told a terrific story, and yet the stock just got obliterated the next day. I felt like I completely missed something. You buy Caterpillar if you think the Fed can reignite the economy by cutting rates. It should have been a winner Friday. Of course, we come back from the weekend, and it turns out that I wasn't wrong at all. Friday was wrong. CAT jumped $4.68 today, making a fool of those who dumped it on Friday. Today, it looked like the buyers had realized that the Fed's rate cuts are going to work. Now, that's a reasonable explanation, but I think there's a better one. Nothing mattered, because nothing really happened at all, except for stocks going zigging and zagging. CAT's not alone. On Friday, many were buzzing about the relentless decline in the semiconductor ace ARM Holdings. The stock fell from 123 down to 117, and this was after already coming down from 132 at the end of the previous week. ARM seemed spent. It seemed done. Then today, it shoots back up to 125. It's up 7%. Supposedly because the new iPhone is using their latest design for custom processors, something that should have been obvious to everyone for months. Was Friday's sell-off based on pure emotion and today's rally based on motion right back? Or did nothing truly happen at all to ARM on Friday or Monday? How about this absurdity? Supermicro, a partner of NVIDIA, fell from 414 to 386 on Friday, still hobbled by a report from short seller Hindenburg about the company's aggressive accounting. But then today, Supermicro were back to almost 410. Again, either the decline was meaningless or the rebound was meaningless, or they're both meaningless. We don't know. Meanwhile, today was still one more day where the recession-proof stocks rallied again. Think the pharmaceuticals, drug wholesalers, they were really strong. Medical device stocks, along with the food and beverages. Feels like these stocks have now made parabolic moves. They're not growth stocks, for heaven's sake. Straight up. That's definitely dangerous with a limited shelf life. Which brings me to the sobering fact about this tape. We have more noise here than any other time I can recall. Noise so loud that people keep making the wrong moves. What should be happening? Look, we know how the market behaves historically when the Fed's about to start cutting interest rates. We've seen it over and over and over again. I built a whole playbook around it at my old hedge fund. Right now, the Fed just switched to favoring easing over the status quo. We got a reaffirmation of that with Friday's employment numbers. We're almost certain to get a rate cut at next week's Fed meeting. So what happened on Friday? I'll tell you what happened. The market made a mistake. At this point in the business cycle, with the rate cuts tantalizingly close, you're supposed to start selling the recession-proof stocks, the food stocks, the drug stocks. The big gains in Coca-Cola and Colgate should be over. It's why we trimmed some Procter & Gamble for the charitable trust. Hey, by the way, that's something we're going to talk about at Thursday's CNBC Investing Club meeting at noon. I wish you'd sign up so you can hear it. Procter's the wrong stock when we're going into a rate cut cycle, and we own Procter. At the same time, you need to keep the industrials that are more secular these days than cyclical, like Caterpillar, or Eaton, the latter, which announced a home electric charging deal with Tesla. Like Cat, Eaton was up huge. More important, when the Fed starts cutting rate, you're supposed to buy the most cyclical companies hand over fist, the ones that are totally hostage to the underlying economy. Companies like Nucor, the largest steelmaker in America. Nucor's done a great job of cutting costs, so if the Fed can stop the decline in steel prices, by just having it so that there's more economic activity, maybe send them back up. This stock's going to be a huge winner. Oh, I know it's hard to buy smokestack stocks in a slowdown. But once the Fed starts cutting, the economy should turn around. You got to anticipate that. That's the playbook. The only real question, do you sell the consumer packaged goods play so you can take that money and swap into cyclicals? And should you go for the deepest cyclicals, the ones that will soar if the economy improves rapidly? Cyclicals like Cleveland-Cliffs, a less efficient steel maker than Nucor. Historically, the defensive stocks get less and less attractive as the Fed cuts rates because their earnings stay consistent while the cyclicals start putting up tremendous growth. Buy! Of course, it's very early to make any of these kinds of judgments. People want to make it. They want to do it. You can't. You'd be anticipating the actions of too many market players. I'm not willing to endorse dumping all your defensives and keep going. I don't want you to go all in on the deep cyclicals. We believe in diversification on the show. But, man, rate cuts are coming. So everything else is just noise, including what happened Friday and yesterday. Apple introduced a new phone, and nobody seemed to care. I think this is one of those product launches that's lost on Wall Street, but eventually loved on Main Street. Wall Street doesn't care about better battery life or draft spell checks or being able to take a picture of a restaurant, immediately seeing the reviews. It doesn't care about AI functionality. The Street just wants to know the rollout schedule so they can make their earnings models. But Main Street wants everything Apple's offering. And you know the wireless carriers will push the new iPhone 16 like they do with every iPhone iteration, which brings me back to sitting on your hands. Most of the big moves are a product of algorithms, which spit out strategies that worked before. They can create a ton of volatility. Rather than trying to figure out what's driving these irrational moves, you should focus on buying dips in high-quality stocks when there's no data, like Apple, which I would have told you, own, don't trade. At the same time, I'd use the strength to sell some of the defensives that have gone parabolic. They seem risky to me. And, of course, you need to judge whether to buy Apple stock tomorrow morning, right? When the negative Wall Street analysts clash with the rabid desire of Apple users to buy the new iteration. That's substantive. I'm hoping for you that Apple opens down. The bottom line, Apple's anemic 9-cent rally was the only true move in a session dictated by larger macro forces that are most likely wrong by themselves, but possibly right when taken together with recent action. So rather than freaking out during Friday's sell-off, or just celebrating today, you could have just sat on your hands and spare yourself the angst and friction that comes with endless buying and selling. How about we go to Kyle, New Jersey? Kyle.
My best friend, Jim Cramer. How you doing, buddy?
I didn't even know we were that close, but you know what? I'll take it. What's happening?
We're very close, man. Listen, I'm just a handyman, and you're like the smartest guy that I know. You're a Harvard grad, and David Tepper's a really smart dude, too.
Tepper?
They just became profitable.
Yeah, I saw that. They didn't have that good a game yesterday, but that's not his fault because he's not suiting up. He should not be blamed.
He should have bought somebody else instead of the Panthers, I think. But yeah. They have a $4.5 billion market cap. They just became profitable. What am I missing in Lyft here?
Okay, so it got overheated. I think Pebble felt that it was like, it's a real true duopoly, that nothing can go wrong. But I'm with you. I think Lyft should be bought here because it is now inexpensive, believe it or not, on the numbers. And you know what? You are my best friend. And I totally forgot my best man, Michael Haley. He's out. He can go to Vegas for all I care. Let's go to Tony in Florida. Tony.
Hey, Jim, I just wanted to know I'm a member of your club since day one, and I really enjoy you and Jeff. But I got to give a big booyah, to your staff. They're so friendly, and they make you feel at home when you call in.
They are absolutely great. And I've got to tell you, thank you for saying that because I don't credit them enough. Our viewers know who to credit. Thank you very much. And just don't forget our noon meeting Thursday with Jeff talking about our new initiation. How can I help you?
Well, I do have some cash on the side for that because that I always listen to. But this stock last week went down with the market, but it went up a lot. I don't have any cyber, and it's a 2. Should I buy just a small of it and then hold it power out, though?
If it weren't up 8 today, I would say yes. I don't want you to come in on possible quicksand, as people may say, you know what? That move yesterday wasn't for real because people are doubting every single move. You wait. That's what you do. You wait. And thank you for the kind comments. On days like we had today, you want to avoid selling what you shouldn't and, well, don't buy what you shouldn't either. How about this? Sit on your hands. On Mad Money tonight. are some chip companies actually a bargain at these levels? I'm taking a closer look at what's behind the semi sell-off and then give you my take. Then I'm going off the charts to get a read on where the deflation trade is heading. And later, I'm checking in with the CEO of Medtronic as he breaks down how AI is shaping the future of healthcare, and it's making the money. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.